Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. Today is June 8th, and I'm sitting here with Ross Marinell. And today we got a special guest. We have Jon Lohr, who is one of our behind-the-scenes analysts at Advisory Alpha, which is our registered investment advisory firm that we work with. So what's up, guys? What's up, Ross? What's up, Jon? Talk to me.
What's going on, man?
It's great.
Yeah, dude, it's great to have Jon with us today. So, special guest of the podcast. Jon is our research analyst. He has going to share some thoughts with us. We're gonna click around a few topics today. So, welcome, Jon. What's going on?
Oh, not much. I'm happy to be here, guys. Thanks for having me on the show.
Very cool. So, Jon, we always start off with something a little goofy and happened in the market today recently, and so I saw this story kick through. Of course, we all remember the ransom that the Colonial Pipeline recently paid. It was reported, Michael and Jon, in the Wall Street Journal last night that the government somehow recovered 64 of the 75 Bitcoin ransom that was paid. So apparently, Colonial Pipeline paid about $4.4 million to the hackers using 75 Bitcoin. Recovered the majority of it, 64. But according to the Wall Street Journal, the cryptocurrency fluctuates dramatically in value. The dollar value recovered was only a little more than half of the value ransom payment. So, fellas, does Colonial Pipeline have diamond hands? Are they going to hodl this back to a gain, or is this just a lost cause?
I personally think that they probably want nothing to do with Bitcoin anymore after that experience. It will be interesting to see what they do, because Bitcoin did drop significantly in value. So they could do exactly what you're saying. They could try to hold it and say, well, maybe we can recover more of the upside if we hang out for a little bit.
Dropping on the news that maybe it's not as untraceable and anonymous as people previously thought.
Which I saw actually a blurb this morning that said Bitcoin was down like 7% because of that seizure. And, you know, I'm of the opinion that that's a good thing. I know some Bitcoin folks would go nuts because they love the anonymity and they love the security of the blockchain. I'm like, you don't want to be the choice currency for criminals. Like you don't want to be that. You want, if there are bad actors using Bitcoin to transact, that we have means to catch them. And I think it's the whole confiscation part that was freaking people out. But I'm like, look, man, if the government can make it illegal too, so let's slow our roll a little bit.
Yeah.
Well, cool. So, we have Jon here today. Jon, there has been a lot happening in the world of just prices of materials have become a topic of conversation. We've seen lumber explode, other housing materials. Kind of share with us what you're seeing on the inflation front. What's it got you thinking as far as, you know, investment allocation, potential upsides or risks? Just get us started. Like, what are we seeing here? What are your thoughts real quick on that?
Oh, that's a great question, Ross. So I think, like, from a little bit of trader talk perspective is we're essentially establishing two sides of the two tribes here. Is one tribe is this a transitory experience that's happening in the economy, and the other tribe would be saying that this is more permanent and here to stay. It is a period that we used some incredible public deficit spending that wasn't backed by any revenues or tax receipts. It was just purely of printing to finance public debt and to put money into the economy. and hopefully see that multiply through the banking system, which I think it's been a pretty successful program so far. On all the reads I see out there, is I get the indication and get the spirit that people are spending money, and it has pushed prices up and sent interest rates down, all that are conducive to stimulating demand. So it's working. It's and you see. Let's see some of the price activities is in the in housing and in other places as well.
But it's good though, because what is, John, what you're kind of touching on is I think we have seen higher inflation numbers than we've seen in a while. Most recent report came out, inflation, or the CPI was up over 4%, and there is a debate right now. There's a debate, like, is this transitory, where it'll even itself out, or are we going to continue to see inflation? And there's two different schools of thought, and both of them have some good points that they make. One of the takes that I've had on that, and as I've shared with that, is one of the things that we've been seeing a lot of in the firm, in the practice, is a lot of people that are holding cash or investing in very, very, very conservative, like, bond funds, where they're more afraid of market volatility than they are of losing their purchasing power. And I've been trying to tell people, like, the market volatility it's ever present if you're going to be an investor, but so is inflation, and inflation is going to run hot, a little bit hotter than normal. We're going to see an accelerated loss of purchasing power, and that's not good for anybody.
Yeah, I mean, I can understand both sides of that argument. Is using treasuries and using bonds to go against or to protect against market volatility, because when you are using things like intentionally kind of gauging the monetary system with public deficits, and you put the inflationary risk in there, it opens up a lot of uncertainty. And so I can understand that argument, but also to your point too, Michael, that if the monetary system is successful in producing enough inflation and sustainable inflation, then it holding cash and holding fixed coupon paying securities is it will cause you to lose purchasing power. Said another way, it's a demonetizing.
Well, so we get these blurbs. I get a Monday morning outlook. One of the economists that's been pretty outspoken about things is Brian Westbury. He's not a huge fan at all of the massive monetary stimulus, and he's one of the few that just doesn't seem to go right in with whatever Washington wants to do. But his Monday morning outlook that he published this week, a couple of things that he pointed out was, he says that the U.S. is still 7.6 million jobs short of where it was in February 2020. He goes, yet retail sales, which fell 20% during the year ending in April 2020, rose 51.2% since then, more than fully recovering. And he says in the past 24 months, total retail sales are up 10% per year on average versus a 3.6% growth rate from 2014 to 2015. He says the only way this is possible is having the government borrow, print, and distribute money for people to spend today. And he made a comment in that piece about the government's essentially printing money to give people to spend to buy products that they didn't make. And it's like we're getting out in front of ourselves way too much with some of this, and we could continue to see inflation as a result.
Yeah, I don't disagree with him. I mean, I think what he says makes a lot of sense. Is economically sound as far as the consumption is being made off of artificial Well, artificial gains, I guess. Maybe that's not the best description, but it's definitely not being made off more of us, more people coming together and producing things and consuming the things that they produce. I will back to the transitory, where I was trying to go at with the transitory or the more permanent change on inflation is a lot of these public deficit spendings is used to stimulate aggregate demand, obviously, but it essentially maybe what we might be seeing in the short term here is we've just seen demand push forward maybe by a year or more, and all the consumption is happening right now. So you see like reports where there might be 7.6 million jobs short. We might feel short on jobs, but retail sales are spiking, and these divergent trends are just a fact of pushing the demand forward. And as part of like the transitory camp would go, or argument might go, is these things are a sudden spike, but we should begin to see these things taper off as kind of supplies adjust and consumption patterns change to the way like interest rates will affect the cost of capital going forward, and many other factors.
We're kind of seeing that a little bit too, because I've been tracking lumber futures, and it looks like it peaked back in early May and it started to come down. So some of those potential prices may be receding a little bit from the initial surge into the spring. And so maybe that's an argument that would support some of that transitory inflation, because we've pulled ahead so much demand because there's been so much cash that's in people's pockets from some of the government stimulus that they're ready to spend a little bit. And so maybe that's an argument in favor of that. How do we see this affecting, I guess the big question is, how does this affect interest rates? And then assuming if we see interest rates start to rise, how we kind of brace ourselves for maybe a rotation in some asset classes.
Well, inflation is, I think over long-term cycles, inflation is probably the largest contributor to interest rate levels. And when I say interest rates, I'm thinking about the base level interest rate in the economy, the absolute guaranteed interest rate, and that is the U.S. government Treasury rate. And in traditional times, people don't have much of incentive to hold U.S. Treasury bills for savings to essentially defer their consumption to a future period if if the interest rate won't earn enough money for them to be able to increase expenditures in the future. And so inflation can take that out. So, if my purchasing power is less in the future, my incentive is to consume now.
Right.
But the consumption now inflation and interest rates are kind of like this balancing factor to kind of match time preferences, current consumption versus future consumption. But yes, as it becomes more expensive to consume in the current day, if this cycle continues to kind of push like this, it should start to drive into the interest rate and cause investors to require more of a return on their capital, per se, like a nominal return on their capital, so they can protect against these price increases moving forward into the future. So yes, I think over the long-term cycle, just recap myself, is inflation is absolutely a huge driver of interest rates, and we would expect to see interest rates go up. And as the base rate, the most guaranteed rate of interest in the economy, increases, interest rates that carry risk along with them, or uncertainty about their future cash flows, are also going to increase as a function of either interest rate or a function of a higher demand on the government to pay more. And that is going to drive. Okay, so if we take a corporate bond interest rate, for example, and it increases, that's going to drive the value of that corporate bond down. But companies, I think, like a rotation-wise in that type of environment it's hard to say.
Well, I think one of the things that you pointed out was what we should expect to see interest rates do in response to inflation, and then you talked about people deferring their spending if they could get a better rate of return or an incentive to defer their spending today. But one of the things that we're seeing is interest rates haven't really moved too much. They're still relatively low. I took a peek at the U.S. 10-year, and it's at like 1.57% this morning. And as a kind of a rudimentary way of kind of checking the wind, if you will, I'll do a quick Google search of local credit unions just to see what they're offering with their CD rates, and it's abysmal. It's abysmal right now. Yet people are still holding these things. They're feeling a little bit of pain, of course, but there's a huge cohort of folks that are just not doing what rational economics would say that they should do right now, which is take the money out of the low interest rate, to get a better rate of return somewhere else. A lot of people are just biting down and enduring the low rate of return on their cash. And so I'm wondering if that's not going to have some interesting effect the longer this goes on, because there's a huge percentage of people that just are very nervous about what the continual printing in Washington and the continual spending on things, because they just feel like it's completely unsustainable.
Yeah, as far as the low rate, I'm actually encouraged to see that interest rates have, they kind of quickly accelerated there off the bottom of COVID, which is probably, in hindsight, should be expected to be seen. When you're going into COVID was an extremely deflationary moment. And what I meant by that is, it was intentionally deflationary. It shocked the pants off me. I'm happy kind of that that economies look like that, we're going to be able to push through this moment, and we did something that was very intentional, like recessionary and intentional to better the lives of people. But when we have so far been able to gravitate our ways back out of this, which has been an incredible experiment to be seen done. But it was an extremely deflationary moment, because as you shut down the economy and you have no transaction, you limit the capacity of transactions taking place and people doing things, is what is going to happen? The prices are going to fall. Well, just likewise, the interest rates fell. And then those low interest rates are expected to get things going back, get things turning around again, and prices to come back up. But so we saw an acceleration of the interest rate get up to, I don't know, I would say it seems like it's had a resistance point of about 1.6% right now. So when it breaks through that resistance, it's kind of like, oh boy, here we go. Are we off to the races? But then when it comes back down through that resistance, we're like, okay, we can kind of take a sigh of relief and breathe here for a moment. I think it's interesting to see that it's the interest rate, like on the 10-year Treasury, is what we're talking about here. It is. All this, the time frame that we've had has just been too short to really make any meaningful description about it or understanding about it. But it is interesting to see the Treasury kind of fight around that 1.6%, and it's actually has weakened since and is getting weaker. Now, to me, that spells that this is a kind of the price action that we've seen as of the last 12, 15 months is could possibly be a transitory experience where we've just pushed demand ahead, we spiked prices, things are going to come back down and moderate. That 51% increase in retail sales, is going to, we might have to see an ugly number for it to go back to average, but these things are mean reverting.
Right.
And that interest rate, that low interest rate, is saying, hey, people, inflation's actually probably, this is like, trillions of dollars voting on this, and saying that the price levels, we may not be we may not be headed back to a 1970s period on the inflation prints, and there are just technology, and this is another topic maybe for later, but technology has done so much in the way that it's changed how we consume in the present day versus how we consumed in the past, that that is a powerful force that the Federal Reserve Bank has to battle against when they're trying to keep a healthy level of inflation in the environment, because there are reasons why that is healthy. It's also what we are consuming too. In the older days, what was consumed in the economy was more of a physical good. Like it was microwaves and cars and refrigerators and whatever. The list goes on. Today, like to your point, Ross, we sit on the internet and consume. We are consuming intangible goods that are created by companies whose assets are like 90% intangible assets.
It's true. I'll give you the best example. My kids play games on their technology. We're not buying board games. We're not buying, tic-tac-toe games and all this stuff. It is done through their technology. You're right. Like the biggest game for the kid, I have two girls that are pretty young, and so their biggest game is Roblox. I talk about it all the time. That has replaced me buying 15 board games because now they get entertainment from that, whether that's right or wrong. But there's ways that we're consuming things that you're right. We're not spending the same things that we were even 10 years ago. And it's hard to track how that consumption is going to change. But I would just put the caveat that we haven't seen interest rates rise substantially yet. But that's I think that's out there. And it's the big question, because if it starts to climb quickly again, that does challenge some sectors of our market more than others. And we've seen this sort of sector rotation happening over the last 6 months from sort of growth to value. And we could see that continue if rates rise. Who knows? I mean, we don't know what is going to happen here.
I mean, we've seen the rotation from, into value stocks like, GameStop and AMC, right? Aren't they in the small cap value index?
Hey, hold up, real quick. I had to just yesterday. I had to tune into CNBC just to see what they were talking about. And on the ticker scroll at the bottom, how they have all the stock tickers scrolling? They must have had AMC stock ticker show up every 10 seconds. Bro, I mean, I had never seen it. It was like you get 10 stock tickers in, AMC again. 10 stockers in, AMC again. I'm like, okay, we get it.
It just shows you that the media will lift their skirt if you're popular enough. It doesn't matter. Like, if you have any substance, they give the people what they want. Give them what they want to see.
I actually, I want to get to all those topics. Those are very interesting things. But I want to just get back on the 10-year interest rate here for 1 second, because I want to throw the inflation hawks out there, those that expect inflation to rise. Some kudos here, because talking about market pricing, there's you can kind of start to break apart the 10-year interest rate into different components and assign like how much of it is attributed to inflation, how much to supply and demand factors, and et cetera. But I'm looking at what they call the 10-year break-even inflation rate right now. And this is supposed to be the yield that lives in the 10-year nominal rate that is representative of inflation. And this yield has been on the rise since the COVID bottom, and it's kind of paused out now at the at kind of like that where it sits today, but it's had a strong upward slope, and it hasn't, it's not coming down to say at this point, but this yield right now, the rate that's being assigned to inflation per year over the next 2 years, say, is 2.4%. And you're going to look at that and you're going to say, whoa, but that's higher than the actual, quoted 10-year treasury rate of today. It's 1.56, but let's call it 1.6. So the difference between those two yields is negative. Right. So, Michael, I think that's back to your point, is that treasuries today are being looked at as almost like the true store of value. I know like a lot of the crypto guys like to get into the store, or guys and gals like to get into the store of value conversation, but the treasuries are the real store of value. They are all basically paying you a negative real interest rate to hold them, which, why would you do that? To me, you pay someone to take the risk away from you. That's called insurance. And so you hold treasuries to protect against unwanted volatility in the future. Back to your point, Michael, I think you have an accurate observation there.
It's going to be, I think, and I'll sum us up with this comment, but I think that the next several months is going to be a massive kind of experiment in human behavior versus economic forces versus fiscal monetary policy, because there's going to be so many different things moving. I mean, they've got tax policy that they want to pass. They've got, an infrastructure bill that they can actually pass an infrastructure bill. There's, I think, Republican support for about $1 trillion in spending if they'll cut out some of the Democratic, more liberal wish list items. I think they could get another $1 trillion spent. And, the economy reopening, and then watching how people now navigate, like you said, John, like post-COVID, where such a massive shock to people's systems, and watching everybody kind of get their life back on track is going to be an interesting thing to experience in real time.
So let's pivot a little bit. So I saw an interview yesterday, I watched it yesterday, from the gentleman who
famed
started the
Warren Buffett,
Bets,
right? Isn't that him?
Subreddit. Yeah, right.
This is Jimmy Buffett, not the singer.
So
Warren's like third nephew from his second cousin or something like that.
I'm not taking that shot, but you go right ahead. So listen, he shared sort of the history of starting that back in 2012, sort of coming out of the wake of the great financial crisis, and just wanting to learn more, explore more, try to make some headway with stock investing. And so he starts this forum, and it has become a little bit of a monster, and the market's having to deal with it. And they're having an effect on stock prices for sure, and also I think the reaction that they're getting from bigger money managers. And so, in the short, I guess what their sort of disruptive model, you kind of have to give them kudos that it's working, that they are causing some disruption. They are able to see prices move in stocks that have been highly followed and used. And I guess, the long-term ramifications of this we shall see. But we're seeing, another GameStop-like reaction in this AMC position. So, of course, AMC is the movie theater. And, it was another one with some high short interest that they've been able to expose and squeeze a little bit. And so there's some fascinating things happening again in this realm, but they've really created almost it's a community, because some of it's entertaining. They post some pretty hilarious stuff. Some of it's a little out there if you're not comfortable with it, but they speak their own language. They have, they try and pass along what they call due diligence and this sort of knowledge center where they're educating and teaching each other. I mean, is this just going to continue? Because when I was growing up, we didn't have a stock forum like this. There was no communication between groups of people across the world that could share ideas on stock investing. I do think there's a sort of a revolution happening, and just the sheer ability for them to share information so quickly about the same topic. And
I think
is this here to stay?
Well, Russ, I mean, there's so much.
John, you got to kick in here, John.
I need this one. And at the end of the show, don't remind me. I got to get back to the asset rotation around value and growth, because on inflation, because we kind of gloss over that. But let's move on. Yeah, dude,
okay.
It's interesting. I love, this is an interesting case study. This is something interesting in financial markets that are happening right now that I'm exploring, and I think, I mean, I'm going to sound like a bear probably on a lot of these topics in so many ways, but I'll provide justification for that later. But there is one thing, Ross, that you said. You said this is a community educating, teaching. Um, that is fascinating. I personally know people that are involved in this stuff, with buying and selling, um, a list of cryptos, a list of meme stocks, and now they're moving into option premiums, and they're learning about what call options are and put options are and how you put spreads together, etc. A lot of this stuff a single person does not need to know. You know, this stuff is designed to be ran in industry, like when it gets into the options. But but it's not that don't nobody needs to feel inclined to be running out here to catch this stuff. But you know, this when I'm listening to people that I know explain this stuff to me, a thought has crossed my mind, and it's like, I mean, it's very cool. Although I think a lot of the views that the people participating in these markets have are misguided and misunderstood. They're not really sure. Like, they don't they don't have clear knowledge about like exactly what they're doing. But what it is helping them do is get a financial education while they're doing it. They're starting to look at stocks, they're starting to look at income statements and balance sheets, and trying to piece together the puzzle, and create kind of mosaics. I think it's way too much of a gambling culture, but they're starting to learn about like what options are in the economy. And I think that's neat. Really, what we should do for young people is we need to have better financial education in the school system and teach them about finances in a in an educational setting. But since we probably haven't done that, they have taken it on the initiative themselves to create a community and say we are going to come out and master this for ourselves, which I do give them praise for that.
You know, I don't know that we will continue to see the same level of, you know, fervor that we've witnessed, because, you know, eventually, like, people are going to be getting back to work. That people that are going to, you know, a lot of, you know, remember, let's go back into like the beginning of all this. We had like this incubation chamber that took place. You know, the economy like shut down. Everybody was forced into their homes, into isolation, onto the internet. A lot of people were given money to put in their pocket, enhanced unemployment benefits. You had a lot of people that were making more money for a while unemployed than they were, you know, so they had money to, you know, pay extra bills. They got stimulus checks. Teenagers themselves got stimulus checks. So, what do you do when you get money in your pocket but you can't go anywhere and spend it? And then all of a sudden, look at what we have. You know, we have Robinhood, we have E-Trade, we have, you know, Coinbase, and then every other crypto. So that's what's happened. Like, these folks got this. And then, of course, we know the second part, or the second act, the market just roared back last year, where literally, if you were just putting money into something, you should have seen returns. And so it kind of fueled this idea, like, you know, that stocks only go up, and all you got to do is just buy stocks. And so this community starts to form around, you know, these different things, you know. And now to get in there, it is interesting to you know, scroll through some of the discussions, because you do have some people in there that are, you could tell they're clearly intelligent and they've done some homework, but a lot of people in there are like, I love it. I'm going to the moon. And you could tell, like John said, it is a lot of gambling culture in there. So
it's entertainment. It's like you're right. It's like, how do we justify going and spending $500 at a casino in Las Vegas? Well, I'm entertained. This is fun. I could be doing something else, but this is fine. And
to me, it's almost like a positive feedback loop for the spirit of people that live in those internet rooms. I feel like, I don't know this for sure, but I suspect, like, I mean, a lot of these people are smarter on like web platforms and things going on in the internet, way smarter than I am. But you know, they have been conditioned to grow up in a culture of like, social media posts and getting feedback to what they are putting out there to their community. And I feel like what better way to have a positive feedback loop than you're somebody that puts your own due diligence out there on AMC, and then you're sitting long AMC and you see that puppy spike, 30% in one day for you. I mean, does that not just send the dopamine flowing? Like
Absolutely. John, 1,000%. Absolutely.
Yes.
I know. I totally agree with that statement. And then for those that crash and burn, they have their built-in support system. Oh man, made a mistake here. Look at this, and there's you look through the comments. Oh, it's okay. You'll get it back. You'll do this. You'll bounce back. Blah blah blah. And I'm like, well, they're playing chicken with, and in some cases, everyone's risking different levels of money, right? And they're risking different levels of their net worth. But we've seen the posts where people are saying, I have my entire net worth in this stock, and I'm going to hold on for dear life. And Michael and I are screaming at each other like, please, dear God, don't do that. Just be sensible. And what fascinates me about this collection of investors is they have this incredible willingness to take sizable stock risks and concentrated positions. So sizable components of their net worth in some cases, at least they're stating, in a concentrated stock that's highly volatile and risky. And they have a willingness to get in, but they struggle so much on getting out. It's like selling is the failure. And I'm like, that is a wrong approach that we're teaching, because you'll see, hold on, don't sell. It's like, but if you invest in something, you have an enormous return. What's the end game? And I think if this end game means we're trying to break the system or hurt the hedge funds or break the 1%, that's a tough thing to execute on.
Well, that's to me that's part of the psychological element of it, because what unites people better than having like a common theme or a common goal or a common enemy, and if you say, hey, these hedge funds, they're the these are the people that have like rigged the game in Wall Street, and quite frankly, there was some anecdotal stuff that happened that was hard to look away from. I mean, when they were doing the squeeze on with GameStop, and suddenly Robinhood goes down and won't let anyone put any orders in, and that was supposedly quote unquote a glitch in Robinhood's order flows, but it, like John said, it just reinforces what they all tell each other in the huddle. They're like, hey, oh, see, they knew we were coming for them. And Ross, to your point, I think this kind of sums up the kind of behavior that I see as being extremely problematic. There was an article written, and this isn't about one of the meme stocks, but it was about Dogecoin. And there was an article written about a guy, the first like millionaire Dogecoin. And this is a guy who like literally maxed out all of his credit cards. He borrowed money from friends and family. I think he may have even taken out like a home equity line of credit. I mean, basically anything that he could to maximize and have access to leverage and debt. He used that to buy Dogecoin when Dogecoin was, they were trying to push Dogecoin up. And well, I mean, if you follow it, that price has dropped significantly, but he still owes all that money. It's not like he didn't even use his own money. He went and like maxed out credit cards, which, credit card interest rates are, like mafia rates. So, I don't know, like, I think that unfortunately,
right,
we may not get the flip side of the coin and hear all the horror stories until something has, the market has had another, steep correction or a drawdown where a lot of these folks that are just left out there, they get massacred. And then we hear all the horror stories about, I did this and I did that and I lost everything. And at that point, it'll be too late.
On Robinhood, kind of creating frictions to trade GameStop. I'm not sure. I'd have to go back and look, but I remember back then there was talks because like when when people buy and sell securities through a custodian platform, the custodians there's a period of time where they're kind of lending them the security as the T+2 settlement time takes place, and Robinhood is churning, taking an asset or giving an asset to their investors when they're buying, but the investors' funds aren't settled yet. So there's a period of time there where there's kind of like a margin or money held on debt, on kind of good faith. And I thought during that time when GME was just going nuts, Robinhood was at a point of almost like it was not going to be able to have the liquidity or something to cover all this this financial mechanism stuff going on in the background, and it was going to maybe cause them to implode on themselves. But Robinhood has some very wealthy private backers behind it, and I believe that those wealthy people injected capital into Robinhood to keep it alive. So, but yes, on the on the dangers. Of what is going on in the market is so I'm kind of I have a little bit of an opposite thought on this as far as like this type of stuff being here to stay. I mean taking really I don't know what this is doing is it's creating so the purpose, I mean, one of the primary purposes of a smooth functioning capital market is price transparency, and I would say what's happening in this small cap market or in these select meme stocks is nothing. It is not price transparency of of any tangible net worth behind these assets. Because I think we agree it's kind of turned into a gambling game. So I kind of feel like it is not here to stay. It is here to stay until the money runs out. And I'm still trying to kind of figure out, like, how does the money run out? Because when I look at this, I see a community or an organization just cycling profits and losses to one another. They may rush in, they may be selling, like right now we've observed the cryptocurrency markets are in decline, but the meme stock markets are on the rise. So that's like profits coming out of one spot to land in another spot. Mm-hmm. And I don't know. I feel like, as this plays out, like the impact that this money flows in and out diminishes over time, and the money runs out. And to both of your points is some people are going to be holding the wrong side of the trade when this happens, and they are going to get hurt and feel it deeply. And that once people start feeling like they just really got stung and they can't trust doing this stuff, and this is for other people, is the confidence runs out. And when the confidence goes, the market goes.
I agree, actually. I think maybe the behavior changes in the way that they're approaching the investments. But this community is not going to go away. That I would bank on. But the thing is too, going back to just risk management and being a good risk assessor. You have the willingness to make a highly risky concentrated bet, but maybe not the foresight to get out. But there are people that do, and I think sometimes they're enriching people that they don't really. May not be aware of, because I was looking at this article through Business Insider. So 6 AMC Entertainment executives took home more than $8 million last week after selling shares of the company amid a massive rally for the company's stock. So check this out. Carlos Chavarria, the chief human resources officer, took home the highest profit with $2.53 million in proceeds from selling 40,346 shares at $62.67 a piece. Thank you, Carla from Wall Street Bets, because 40,000 shares in January was probably worth between $80,000 and $125,000 or $130,000. And the popularity of that stock pushing it up, she had the foresight to say, well, $62 is a pretty good share price for me to sell my 40,000 shares. And so she did. And so I just think about these people holding forever, or this is to like
Well,
hold the
Russ,
line. And I'm like, I think that, like to John's point, people are going to lose money.
I don't know, but as someone who just can't stand short selling altogether, it wouldn't hurt my feelings if we got rid of it. Period.
I mean, my point is, if that is indeed happening, I've been being told it was, but I've never actually gone out there and confirmed that myself. That was my point. But if that's actually happening, that's creating a friction in the market where you cannot get to price transparency. Is GameStop or sorry, we're talking about AMC is high. I'm trying to look up the. Anyways, still matter. It's a $26 billion company right now, being valued at $26 billion. Anyways, it's the stock price is high, and short sellers can't get access to the inventory to sell it. It's creating what it's creating. I feel like it's creating kind of an artificial support on its high market valuation right now.
Oh yeah,
And that's a friction in the market. I mean, it's like if we can, as soon as that friction is removed, if it is there, you pull. It's like you pull the carpet out from underneath the, or the tide goes out and we see who's swimming naked, right? I use the cliche.
What it's having an effect, and this is the effect. I was looking at the iShares Russell 2000 Value ETF, ticker IWM. And right now I'm showing the top 3 holdings. 1 is Caesars Entertainment, 2 is AMC, and 3 is GameStop. Now, we'll see how that shifts over time. But
yes,
these stocks are getting tracked in, a higher exposure in ETFs because of their market cap. And so this has a trickle-down effect. And in some ways, well, it's helped this index also perform well. The
patient investor, it does kind of penalize them. These price discrepancies or these frictions in the market, it impacts what capital markets are intended to do or designed to do. And you got the meme stocks sitting in the top 10 of market cap weighted financial vehicles that investors use to gain exposures to certain asset classes, which is, I think it maybe opens the door to very high volatility in the future. I mean, if we're talking about these stocks kind of being in bubble mode, which it sounds like we kind of are, just being inflated off just pure speculation and greed through Wall Street bets.
Mm-hmm.
These, and they get pushed up to the top of the holdings that people are holding as in investment funds. If the air is let out of these things, people holding the small cap index or whatever should be expected to see the small cap index come down in its market capitalization or its total equity value. Now I'll say if you've been holding small caps for a while and you rode it up with this experience, you probably don't have much to worry about. Even if you come down, I kind of just look at it as like, even if it went up and down, it was kind of like gains that were there that probably weren't supposed to be there in the first place.
Well, John, to your point, and kind of to talk a little, just to touch on what Ross was saying, is
they certainly should have some cushion.
Yes, your investors that are using funds or an index fund, for example, to gain exposure. It's also a time for them to be disciplined and realize what's going on, and rebalance the weighting of that in their portfolio, and versus just letting it go way outside the tolerance band that they would have for that specific allocation, unless someone's just all in on small cap value, which I'm sure that someone out there in the world, that's their thing. But for the most part, most people aren't doing that. But it's like, hey, whoa, this position has really grown. That's an opportunity for them to practice that discipline that we're talking about and rebalance that into, some of the other, positions. Otherwise, if you're like, well, this, I can't sell it now because it's up 60%. Well, that you're doing the same behavior that these people with the stocks themselves are doing. Just you have a little bit better diversification to help your downside. But it's the same behavior.
Yeah, it's a great. I mean, it would be a great time to kind of look at what that small cap weight is in your portfolio and where it should be. Uh, for your strategic goals or your long-term investing goals, and if you are out of balance there, I mean, what a great time to take, you know, set take some profits, sell high, and get back to target. Can I say one more thing about this what's going on too is I am there's another component of this I'm becoming increasingly more interested about, from like a theory of like capital allocation. And I'm completely open to this Wall Street Bets and this Reddit group saving these companies and proving me wrong. And I will be the first to shout them praise if AMC can reinvent itself into the next mainstream company that's going to be in American lives for the next 20 years, But this is a really interesting thing because we've seen these companies now. They've had, their share policies. They've had shares in treasure. Anyways, I don't need to get into details, but their share policies have make it possible for them to put more shares out into the marketplace. Basically, get a bank to put more shares, to go out and issue shares and raise capital and bring it into the balance sheets of these companies. And we've seen GameStop is doing a share. Has issued shares, and AMC is now the latest news on another company issuing shares, taking advantage of the high stock price, issuing shares. It is funny though. You said that was the CFO of AMC that was selling stock.
The chief human resources officer.
And things, you got to ask why they're doing them, but that insider might be saying there's no way. Like, this is a free lunch, but but anyways, back to the capital allocation is we are giving companies that are secularly, their business models are on a decline. Like, the movie theaters aren't what they used to be back in the day, or retail, conducting video game transactions through a retail shop, a physical brick and mortar shop, is not really what's happening anymore. Or media, things have changed. So it will be interesting. I mean, if these companies are able to take their stock proceeds and reinvent themselves into companies that actually are serving the current economy, that's going to be an incredible accomplishment, and it's going to take some serious brain power by corporate managers to figure that out. But what I really hate to see is a capital allocation. Our economy or our society experience a moment in time where we're rewarding dying asset. We're extending more life to things that through the natural, natural voting machine of money, that are meant to go out to be replaced with other things
that are going to die. Yes.
And I would just hate to see, like, people are going to be holding AMC shit. That AMC is going to get a whole bunch of capital, and all that capital is going to be to do is spend more money on expenses than take more money in on revenues. It's just going to be 5 years of just depletion. That money went nowhere. It was a deadweight loss. I'm off my soapbox now. So
they bailed out the bondholders, and all the executives get to exercise their stock options.
Okay.
Yes.
This is where I diverge from my appreciation of the Wall Street Bets crowd. Is you have a tactical trading position. Listen, if you can legally make money trading a stock, go for it. Don't try and tell me the justification as to why it's worth that price, because I'm not hearing it. And I look at these dying industries, I'm looking at revenues declining dramatically, and I see the capital infusion. And to me, every dollar that gets in there is a wasted opportunity for that money to be in a better business, in the hands of a better allocator, in the hands of a better executive to manage that money and produce something more for our economy. So I'm fine if you trade to make money, you're having fun, you're learning, go for it. don't try and tell me the justification as to why some of these things are worth it, because I don't see it. The pivot they would have to make to be worth that amount of market cap is unbelievable, in my opinion. That's just me.
Well, that's
so have fun trading, make money, but don't try and tell me AMC's should be valued at this price.
Well, yeah,
point.
do we want to go? I mean, dude, do we want to be stuck in a dinosaur age of going to the movie theater is a fun experience. Don't get me wrong. The popcorn, the smell of it's not going to go away. It's just probably its footprint is too large when media can get direct to the consumer now. It's almost like the distribution channels don't need to be as large as they once were in the past. But
well, that Ross, what you were talking about is what we tell people all the time is we buy emotionally and then we try to justify with logic, and so that's all that is. It's like, so why did you buy it? And people start trying to tell you like 10 different reasons, like this analysis that they've done, and like that's not why you bought it.
No, it was a funny meme. You laughed. You have, it's funny. It's like. During that interview with the Wall Street Bets creator, he was talking about leverage, and I'm like, these kids, they have cell phone leverage. I call it cell phone leverage.
Well, that's one thing I noticed with talking to the individuals I know is, I mean, I could not believe, I've been standing in front of them, I could not believe how quick they could pop their cell phone up and trade real life money. It shocked me. I was like, I didn't even know that was a possibility. It shouldn't be. But like, I just feel like it. But I could be wrong in that. But another example is, I was talking to an individual who bought call options on a particular stock, and this person has zero experience with any options. They don't even. I said, okay. My question to them was, you know how to close that call option out when the time comes, right? Oh yeah, they've got it all set up for me. All I have to do is push this button that says close option or something. I was like, oh, okay, well the brokerage entity or whatever is doing the mechanics for you behind the scene, and that makes it better for the consumer. So that's awesome. But I was like, holy cow! It's just. I think it's important for a person to know what they're doing if they're going to do these things. If you don't know what you're doing, you probably shouldn't be doing it.
Hey, John, we will, not only will we hand you the hand grenade, we will pull the pin for you.
Yeah, yes.
Now, I mean, we're kind of joking about it, but this is reality that's being lived. And yes, there will be a handful, there will be some people make significant profit, and all kudos to them, and I'm just fearful of those that are going to lose more money.
I think a lot of people are going to, I think there's a trap out there to get caught into, and it's just, I'm personally trying to make a choice. I mean, I don't believe in what's happening, so I'm not going to participate in it. But I also like on principles too, is because of like the human emotion that can come out of this is someone can begin to say, I'm only going to put what I can lose on this stock, and most of our responses are like, have fun, I hope you make lots of money. But what I think where the problem could compound, if you are lucky, you're on the lucky side of the trade, and you hit 50% return, and maybe you do that 3 or 4 times, and it feels good. Your overconfidence really starts to overtake you, and also the goodness of that feeling of like, again, the positive feeling, but being on the right side of the trade is. What you were willing to lose might accumulate into, well, now I'm doing good at this. I'm pretty well. I must have a talent for this. I must know what I'm doing. And it accumulates to a bigger pool of capital and a larger pool of capital and an even larger pool of capital. Pretty soon, I'm not saying this is going to be for everyone, but there might be some out there that they do find themselves overstretched, and they didn't even intend to start that way.
I can't agree more. I think we're living it. We're seeing it in real time.
But amen to those people that are making gains on, I don't know, Dogecoin and then going off and paying off mortgages. I mean, they're using fake money to make real money decisions. I love it, but oh well, okay.
No, I mean, there's always, I mean, and that I think that those people that do that, to me, like, they should be commended because, yes, I mean, do we fully understand? No. Do we think it's like, fake unicorn money? Yes. But they reap the economic benefits of it, and they're taking that and they're doing something that could be like life-changing for themselves, like paying off a mortgage or paying off student loan debt or something like that. And
100%.
People that have that type of fortitude just to say, you know what, hey, this is my exit point, I'm out, this is life-changing for me, those people should be absolutely commended for that.
Yes.
But you know what, I think one thing, and we're on the hour, so I'll kind of begin to wrap us up. But one of the things just I've kind of thought about while we were sharing was there's always something, right? When it comes to investing, there's always going to be something that's going on that is a temptation to pull people off of their plan when it comes to investing. There's going to be inflation, so you got to hurry up and do this. Or, there's people making boatloads of money over here doing, trading meme stocks. You need to like get rid of your boring portfolio and get over here and get this growth. There's always going to be some story in the background driving a media narrative, driving headlines that is there really just as a distraction to keep people from staying focused on what their long-term plan is. What do you guys think about that?
I think you sound like a wise planner, Michael. That's what I think. So, yes, you're right. I think that I agree with everything you said.
Because like you said, there's forces pulling us left and right all the time. And sometimes the best thing to do is just stay the course.
Investing favors the patient. That is so true. Because when you're investing, you're looking for, we'll assume you're investing in businesses. And when you're investing in businesses, your thing is to look for strong businesses. And strong businesses don't print money overnight. It takes time for their growth to happen. And when I look at businesses and what size, what they're being valued at and et cetera, and look at kind of like what they're trying to accomplish, I try to think about, 7 to 10 year period, if this, product grows, or product or service grows and it gains market acceptance, and there's actually a addressable market out there that's not being served, that this company will eventually serve more as the product gains acceptance, is the company's value could move higher and translate into compounded returns. But that is a process that takes time to happen. Yeah. And so I think that was investing favors the patient.
That's a great analogy. I mean, we say all the time, we can't microwave our way to wealth, and it takes time to do that. So, well, thank you all for just joining us with this chat. I would say fireside chat because it had that kind of feel, but we're all in our little home studios right now. So, but John, thank you for joining us, and we'll definitely have to get you on here again to chop it up a little bit more. John writes market commentary for our advisory firm, so we'll make sure we share some of that with you guys as he puts that out for us to provide for you. And thank you guys for listening. If you got anything you want us to talk about in future shows, I know there's a lot of stuff out there where people have questions. Feel free to shoot us an email at themoneyhuddle@vcplanning.com. And as always, we'll talk to you next time.